I think that we are in the 1970s until late 2027 or early 2028. Then I think we will, instead of having a recession, we will actually have a depression because asset prices will collapse. And when asset prices collapse, you then will have a depression.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Simon Hunt. Simon has more than 5 decades in the financial and commodities space. In 1996, Simon founded Simon Hunt Strategic Services. The focus of the company's work is to provide strategic advice, including geopolitical and financial developments, as well as structural and tactical changes within China in order to produce a balanced outlook for the supply of and demand for copper. Increasingly, the work involves understanding the shifts taking place in the balance of global power, including how the BRICS will change the dynamics of the world and how these changes are going to impact the copper industry. Simon is also the author of the Frontline China Report service, marked by the TIS Group, and is also on the board of directors for the Great Eastern Gold Company in Australia and Copperman in Chile. Simon, thank you so much for joining us today.
Well, it's my pleasure.
So let's begin with a look back on 2024 from an economic and market perspective. What surprised and shocked you? What fell right in line with expectations? And what are you expecting moving into 2025?
Big questions. Excuse me. The first point I'd make is we haven't come to the end of 2024. A lot can happen between now and the end of the year. And I think one of the major issues we need to watch out for is before President Trump gets into office, that the powers behind the throne in Washington produce a false flag operation, either in the Middle East or in Ukraine, in Europe. So, so to answer your question, so far in 2024, what has surprised me has been the continued strength of the US economy and financial markets. The question that we then have to pose is how much of the supposedly strength of the US economy is actually manipulated data by the BLS, etc. I think it's very likely that early in 2025 we're going to see some very big revisions in the BLS employment and unemployment data. And I think maybe we will see also some revisions in consumer spending, et cetera, et cetera, et cetera. On top of that, from what I pick up, there has been an additional several 100,000 government employees put into government in the last few months in order to bolster the economy in front of the elections. Well, as soon as Musk gets his hands on the till, as it were, those several 100,000 will be out on their ear, and many others too. So I think that the combination of data revisions, the work of Doge, and growing, escalating conflicts around the world, the first 6 or 9 months in America next year are going to be very difficult. It's not going to be an easy road to tax cuts, etc., etc., and the boom that President Trump wants for the economy and financial markets. So I think that in the first half of next year anyway, the economy will be seen to be in trouble. Interest rates will therefore fall. Inflation numbers will continue to decline. The Fed will put its foot on the credit pedal, and by September, we'll have gone through the difficult phase, and then we are probably going to have 2 years of strong recovery in the US economy, but very inflationary. Part of the inflation will arise because of escalations of tensions in the Middle East, which we can come on to later, which will mean that energy prices, instead of falling, will be rising. And when one looks at what's happening to weather conditions, food supplies will become very tight and food prices will be rising rapidly between the end of 2025 and 2027.
So you see inflation coming, pretty good large scale inflation coming, and you mentioned the Fed putting their foot on the credit expansion. Yeah, the accelerator. Are you expecting another round of QE money printing, that type of thing?
That sort of thing. I'm sure it won't be called QE, it'll be called something else. But the bottom line is that markets will experience more than enough liquidity. And you will certainly see the liquidity accelerator being conducted by the ECB. But Europe is in a completely opposite situation to America. Europe has not only got very significant economic problems to face, political also. I mean, just take one example, Germany, the powerhouse of Europe. Volkswagen has announced it is closing 3 of their 7 factories, laying off 30,000 people. But then when you count in all the ancillary industries, the guys that produce the parts, the shoppers, etc., you're actually talking of 250,000 being unemployed, arising from Volkswagen alone. So then on top of that, you've got very serious political problems, a German election, which will probably see a new government. France is in an extremely difficult position. So then if we turn to Asia, everybody is negative on China. I think that actually the foundations are being laid for a strong Chinese recovery in the second half of next year. I think they have still held back a lot of stimulus, monetary and fiscal, that they can introduce, but are holding back until they see the extent to which President Trump will try to contain China by tariffs and sanctions. My guess, and it's only that, is that Musk will be Trump's intermediary with Beijing. Trump knows Premier Li very well indeed, as Li supported Musk's factory in Shanghai. And it's obvious that President Li has a close association, that Premier Li has a close association with his president. So I suspect that the outcome will be enough will be imposed on China to satisfy the hawks in Washington, but not enough to totally derail China's economy.
I appreciate you laying out that from a global perspective. So you recently wrote that the 10-year U.S. Treasury should yield over 10% in late 27 and 28, though these dates could be brought forward by wars escalating. Would you speak into that for us?
Well, yes. I mentioned earlier that we are going to go into a strong recovery in America, but one that is highly inflationary, starting towards, say, the fourth quarter of next year and lasting into around 2027. Inflation, or to use the American terminology, CPI, is very well tracking what we experienced, or at least some of us did, in the 1970s and early 1980s. And if that tracking continues, which on our work it will, then we will see US CPI in double-digit numbers by the end of 2027. Now, what does that mean to the bond vigilantes? It means that 10-year US Treasuries, over which the central bank has limited influence, will then be in double-digit numbers too. Just remember that when inflation peaked in America in 1980, CPI was 13%. And in 1981, if my memory serves me right, the yield on 10-year treasuries were 15%. In those days, government debt and private sector debt was pretty limited. It's no longer limited. So what is that going to do to the American economy and thus to the global economy? You're going to have a mega crash.
So so you're predicting that once the rates hit that high, then that's going to lead into a crash. Some experts I've had on metals and miners believe that we're in a roaring 20s type environment, like a 1920s part two. Others have said we're more in the 1970s. So it sounds to me like you believe we're more in the 1970s.
I think that we are in the 1970s until late 2027 or early 2028. then I think we will, instead of having a recession, we will actually have a depression because asset prices will collapse. And when asset prices collapse, you then will have a depression.
Okay. So let's transition that right here, Simon. US stocks are trading at over 22 times forward earnings versus 14 times for international stocks. That's the widest valuation gap in history. What's the takeaway here, and do you see a reversion to the mean coming?
You know how to ask the difficult questions. Um, as the data rightly shows, America has been seen to be the place where you should park your money. I suspect that when we are going to have, starting maybe any day now, a big correction in US equities, possibly as much as 20%, for instance, in the S&P, and maybe as much as 40% in the FANGs. This will coincide with the dollar, which has been strong, will start to weaken. And funds will then say, we've had a great run in America. Let's diversify our holdings, particularly the foreign funds that have moved into America. So with the dollar starting to fall sharply by mid next year, you are going to see other markets beginning to outperform American markets. You're going to see the dollar index probably now at going to rise to probably 110 by early next year. By the end of next year, probably to be at around 90. So it's the end of 25, end of 26, it's probably going to be around 80. By 2030, 50. Now, what is that also telling us? It's telling us that the BRICS group of nations, slowly, step by step, will be conducting their trade and investment without using the dollar. It's already happening between Russia and India, between Russia and China, in odd lots between Saudi Arabia and China and the UAE in China. The interesting thing is that where a country has an excess surplus with its trading partner, like Russia has with China, then gold is used as the intermediary asset. So, for instance, from what we understand, Russia's surplus with China is balanced by the equivalent amount of gold being held in the PBOC for account Russia. So what I'm saying is, slowly, we are seeing gold re-emerging as a monetary asset, which is also indicated by the fact that central banks nearly everywhere are diversifying their asset base. I think the big shock to markets that will come probably within a 2-year period, maybe very soon, I don't know, is that the day will come when China will announce that its currency is supported by the gold which its citizens own, which on our work is north of 25,000 tons.
So, okay, so you paint the picture with the BRICS here. President-elect Donald Trump, he recently shared that if any of the BRICS nations move away from the U.S. dollar, he's going to impose a 100% tariff on them. So you have this idea of the BRICS moving away from the dollar and having this cohesive bloc and the success that they're pursuing, excluding the dollar from their transactions. And then you have President Trump and the new administration on the other side here. They seem to be at odds with each other. How do you see that playing out?
In the end, there is only one answer. In the end, whether it's 25, 26, 27, 28, or 2030, who knows? The end result has to be war, because diplomacy no longer exists within the American toolbox. It's only war. What have they done in the last 20 years? Wherever a country has said it's thinking of not using the dollar, there's been war.
Now, Trump is the one president who has not started a war and has pledged to not start a war.
That's what he's saying.
Yeah.
I
But
mean,
you feel like all roads lead to war because the BRICS have no choice but to move away from the dollar in order to protect their trade and their economies, and at the same time, America is going to do everything that they can to hold on to the dollar being the reserve currency and the middleman between all transactions, and therefore, there's only one conclusion.
yeah, but we go it can go at any moment, but I think the first phase is that the Trump administration will and is already started to pry countries away from BRICS. So, stage one, how can we separate China from Russia, where there is this very strong strategic alliance? So, the Trump administration will probably offer something to Russia to persuade them to break with China, and they'll do the same with China. My view is that that alliance is too strong and will not succeed. The Washington has already been successful in starting to break Brazil away from BRICS. The powerful ministries in Brazil are anti-BRICS. President Lula is under pressure. Whether he goes along with the big ministries, I don't know. But the pressure is such that there is a real chance that Brazil will break away. Then Washington, for years, has been very anti-Iran. And with Iran's supposed success in defeating Hamas, defeating Hezbollah, and I emphasize supposedly, with the collapse of the Syrian government and with Lebanon being in such dissolution that Netanyahu may well feel that the time is right now to launch an attack on Iran. There is also this strong belief in Israel, in Washington, and the capitals of the West that both Russia and Iran have been so weakened by the collapse of Syria that they are in no position to offer a strong defense. So I think the risk is growing, possibly before the 20th of January, but certainly in 2025, that there will be an attack on Iran, and Iran will retaliate very strongly. Its 2 missile hits on Israel were to send a message, and those hits managed to get through all of Israel's and America's defense systems.
You know, you very well may be right with Iran being next. I mean, if you look in the American news, there was a congressman from New Jersey who came out in the last couple of days saying there's been some drone activity that has been very awkward for the citizens of New Jersey. They've been commenting on these drones that they're seeing in the skies, that they're the size of buses, they're the size of cabs, they're huge. And he came out and said that they were Iranian drones, and that, I don't know if you saw his interview, but he literally said this. He said that there is an Iranian mothership parked off the coast of the United States controlling these drones. Now, of course, this just sounds so absurd, an Iranian mothership, as if our Coast Guard, our Navy would allow that to be there. But it seems like what he and, you know, probably some of the other figureheads are looking to do is to soften the, you know, the American population towards an eventual attack on Iran.
I think this is by the sound of it, it's one of these many false flag operations that the powers behind the throne in Washington are trying to orchestrate in order to start a war before President Trump takes office.
Yeah,
that's why I think that from what I'm piecing together, there is this risk that Israel will attack Iran before the 20th of January.
So Trump has no choice but to oversee a war in that case. Yeah. All right. Well, let's shift over to China for a moment here, Simon. They announced the other day that they were going to loosen their fiscal policy for the first time since the 2008 great financial crisis. And right after that, gold, silver, and the miners, they responded. They soared. Now, it's been choppy since, but is this the likely launch pad that many have been waiting on the precious metals and the miners to truly take off, where China, in conjunction with all of these other central banks that are loosening policy around the world, you now have global loose policy. Is this the launch pad?
I think it's the start of the launch pad in China. It's both fiscal and monetary. I'm told that there are other measures that have been held back until they have a better idea of what President Trump is going to do.
Right.
So, yes, look at it this way. China's recovery will gather momentum in the second half of next year, especially in the fourth quarter, which will coincide with America's recovery starting to get in place. Whether the easing of policies in Europe are going to have any significant impact is a different question. But if you've got the two major economies in the world recovering at the same time, then yes, the precious and base metals will start taking off. I mean,
So
on copper, for instance, at the moment, so many people are saying that physical consumption in China is dead and buried. It's not the case. It's actually quite good. And if you look at what's happening to Shanghai copper stocks, every week they're falling. So you just need one. I come back to what I started. The first 6 to 9 months of next year are going to be very difficult, and economic growth is not going to be encouraging. Physical consumption for base metals will be weak, so prices will fall. But following that, you will start a 2-year boom.
Okay. I do have a specific question for you on copper in a moment, but Simon, I wanted to ask you about this global financial services giant Nomura. They came out with a list of 6 potential gray swan events, not black swan events. They're calling it gray swan events for 2025. Here's the list. Number 1, an NVIDIA crash. Number 2, the yen carry implosion. Number 3, the U.S. 10-year yield above 6%. Number 4, a U.S. growth shock. Number 5, geopolitics gets completely out of hand. And number 6, China stimulus falls short. Is there one from this list that you believe could realistically happen in 2025? And if so, how should we prepare?
I think they must have been reading what I've been writing. They don't, unless that I know of anyway. I agree with all of them apart from the last one.
Okay. So you
And
think
I'm not going to quote what our technical associate is saying on NVIDIA or on the FANGs, but they're not just short corrections.
Okay, so you're seeing a
And
combination of events that
yeah,
that'll
yeah.
likely take place in 2025.
Yeah, yen carry trade, absolutely. Where's the global liquidity been coming from? Japan. So what happens when I was told just only yesterday that the real exchange rate of the yen dollar should be 88. That's what
Wow.
history tells us. Where are we now?
Yeah.
150 plus?
Yeah, something like that.
So we've actually got, by the end of next year, the dollar yen at 114. What
Wow.
is that going to tell you?
Yeah.
Money goes back into the money that has exited Japan will come back into Japan to support their own economy.
Interesting. I'm getting the picture of what happens with a tsunami. You know how the water recedes out and then it comes over. I'm seeing that with the way you just described that. All right, so the combination of Eastern and Southern central bank gold buying and all the central banks replacing their dollar reserves with gold, that is got to lead to unprecedented demand for gold for many years, and that just doesn't seem to be stopping. So if this continues to play out, do you see the substantial increase in physical gold demand only being satisfied by much higher prices? I mean, we're not seeing massive changes in supply, in production.
It has to be. I mean, China has just announced an enormous new gold deposit, but how long will it take for them to start producing from that deposit?
Probably at least a decade, right?
Well, I don't know, but certainly a long time.
Yeah.
No, the price has to go only one way. I mean, the world exists on fiat currencies, or the Western world exists on fiat currencies. And that is the problem with that BRICS faces. I mean, take a simple example. A 1980 dollar is now worth 22 cents. A copper producer, say in Zambia, in for its production, it has received mostly dollars. It thinks, oh, wonderful profits, but they're not. They're illusionary. So, what BRICS wants to do, and it won't happen overnight, may take 5, 10 years, is to replace a fiat currency with a currency that is largely backed by gold.
Something that's going to hold its purchasing power.
Yeah. Look at it another way. China has been selling US treasuries. I can't remember when it peaked, but some time ago. Where have they invested? Physical assets,
Mm-hmm.
building roads, um, ports, etc., in other countries, because they look at the long term. They're not short term operators. So they want physical assets for their surpluses.
Yeah. So, Simon, silver has been in deficit for more than 4 years. The deficit is rising while supply is very stagnant. Demand is escalating everywhere that you look. Russia just recently said that they're adding silver to their strategic reserves. Countries are getting more protectionist and nationalist around the globe. Investment in mining has been low and stagnant for 15 years. And silver's production is largely a byproduct of mining other metals. So if the market finally gets to the point with silver where there's not enough left in production plus above ground stocks to satisfy the insatiable demand that everybody has, will price even matter at that point? I mean, won't possession of the physical metals really be the only thing that matters at that point?
Oh, yes, definitely. I mean, when private people ask me, what should I do if you're right that we're going into a very difficult environment? I say you need to own the house that you live in. You need to keep enough cash to pay for your daily bills. And the rest you should largely own in silver and gold. I mean, I've got here um, a large number of silver bars, for instance. in my safe here. So you need also to have food security. You need power security. How do you get power security? You buy one of these generating sets that from which you can run your whole house. They're powered by folding solar panels.
So gold prices are in the midst of a substantial bull market, yet investors' interest in gold equities, it remains eerily muted. By several metrics, gold stocks today are as cheap as they were in 1999, 2000, a period that was marked by deep skepticism and relentless selling from, European central banks, for instance. What moves the market back to gold equities similar to the 1970s and the early 2000s?
Markets are driven by A1. The rest of the market is forgotten. So when A1 stocks run their course, that money will go into basic things like gold, silver, mining companies. And I think that could well happen over the next few years.
So you see a rotation taking place.
Yeah.
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 Yeah. So industrial metals, they have faced headwinds in recent months as weak economic data from China and fears of a cutback in U.S. climate-related spending have outweighed concerns about longer-term supply shortages. However, in 2025, do you see tightening fundamentals once again supporting metal prices as the global energy transition continues and the number of new mining projects disappoints? What do you see ahead in 2025 for copper?
I think the first 6 to 9 months you'll have falling prices for the reasons I told you earlier. The recovery starts late in 2025. It's highly inflationary. So you will see physical consumption rising quite sharply and will be associated with copper being used as one of financial markets' traditional hedges against a falling dollar and rising inflation. So by the end of 2027, early 2028, on our work, we go from a low point next year of around $6,500 to $7,000 to about $14,000 by late 2027, early 2028.
Interesting.
And other base metals will follow similarly.
Okay. So, Simon, is there a commodity sector right now that you view as being on sale?
Being what?
Being on sale.
What do you mean?
Meaning it's mispriced to the downside.
I've just named one.
Copper. Okay. All right. Well, this has been a fantastic conversation. Before we wrap up here, and I ask Simon our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Simon as much as I have. Please let him know. hit the like and subscribe button, and leave a comment below the video. All right, it's now time for the Golden Nugget segment. Simon, let's discuss a future scenario that I've been asking several of my guests lately. Picture a dinner party. There's two tables. The year is 2029. One table's very happy. One table is very sad. The reason why the table is happy is because of what they invested in right now, 2024 going into 2025. The other table that's really sad is also because of what they just invested in 2024, 2025. What do these two tables represent to you in terms of asset classes?
The happy table is the table that is invested in physical assets, whether real estate that they live in, not they invest in, gold, precious metals, and base metals. The unhappy table is the one that invested in all of the current boomers in equities, and those that at current yields in the US 10-year Treasury market went long of the market.
Interesting. I appreciate that. Simon, thank you so much for coming on to Metals and Miners, for being so generous with your time, analysis, and ideas. It's been wonderful to spend the time with you. Would you care to please summarize your views that you've covered today and let those know who are tuning in where they could learn more about your work and how they can connect with you?
Well, to summarize, very simply, play the cycles. Don't invest for the long term. So the cycles are markets fall until around mid next year to September next year. Then you have a 2-year bull market followed by a big collapse. Anybody who wants to get hold of me, two ways. My email is simon@shss.com, or else simply simon-hunt.com.
Okay, I will have all that information up on the screen, and it'll be in the description area where you can click through. I've been following you, Simon, for a couple of years. I've been watching your interviews and reading some of your work, and I really appreciate your viewpoints. Thank you so much for coming on to Metals and Miners. I look forward to having you back on sometime soon. And everybody else, thank you for watching.
Well, thank you for having me on. I've enjoyed it.
My pleasure.
Thank you.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.